What you'll see in this video is the introduction to the initial radioactive trading married put structure, direct from the power options search and related to recent positions in the Fusion portfolio. We're going to show how that structure meets the three core principles of trading: F.I.S.T, forcing an ideal size trade, the radioactive decay or time decay curve, and the at-the-money bell curve. We're also going to show the expectations of the preferred structure versus cheaper insurance. Why not use a 1-month output compared to our preferred strategy? Why pay for the in-the-money intrinsic value on our preferred married put position rather than an out-of-the-money put? The radioactive trading married put is designed to properly control your risk on your stock positions for uncertain markets and unknown events. The preferred structure is we're going to buy shares of stock and protect the holding. The married put is not a new strategy, but the proper radioactive trade does it a little bit differently. We're going to buy a far out in time, at least 150-day out put option that is also slightly in the money, rather than looking for cheap insurance that's just 15, 20, 30 days out in time at a lower cost out of the money below the current stock price. An example directly from the Power Options search on December 29th, 2022, we could buy 100 shares of Charles Schwab, SCHW, at $82.65. In the preferred structure, we may also buy one 16th of June 2023 expiration, 169 days out, 85 strike put, slightly in the money above the current stock price for $7.65. The total invested would be $90.30 per share, or $9,030 total. The put option gives us a guaranteed exit, no matter what happens to the security, of $85 per share. So the maximum risk on the position is only $5.30, or 5.9% of what we invested into the trade. Of course, it's a positive delta bullish position, so we have an infinite, uncapped upside profit potential. The initial benefits of the structure: long-term insurance to avoid market uncertainty, at least 150 days or more. Single digit at risk for the unknown as well. The absolute worst case scenario is only a loss of 5, 6, or 7%. Slower time decay working against us on that second purchase of the far out put with the proper structure. We also have a lower annualized cost of insurance. We'll talk about that in just a moment. And that put is actually a second working asset in our favor. Now, we paid an additional $7.65 for this put option on top of the stock purchase. So we add a loss immediately? Are we immediately down $7.65 or the $5.30 maximum risk? Absolutely not. The only thing we're risking at the time of the purchase is any slippage from the bid-ask spread of the put option or any small slippage on the stock. Here, just a few moments after we entered this trade into the Power Options portfolio, we see that the stock is down about 5 cents from where we purchased the position, and the put remains essentially at the same value with the midpoint price. Although we paid $9,030 to enter the position, the current liquidation value a few moments after we entered the trade is only 5 cents or $5 less. We're only losing $6 or 0.1%. We're not behind the 8 ball immediately when we open this position. It doesn't go to zero as soon as we buy the put option. We have time on our side, and the only thing we're risking is the bid-ask spread. Why would we increase the cost basis so much and the break-even of our initial holding? That cost basis of $90.30 per share, or $9,030 for buying the stock in the preferred put, sets the break-even at $90.30 per share. But that's the worst case scenario. That full loss would only occur if we held the position all the way to June expiration, decided to not do any adjustments or income methods against the preferred married put structure, except no dividends, and the stock remains below the put strike price of $85. On the left, we're seeing the expected profit and loss chart of the halfway point on March 24th, 2023, halfway between now and June 16th expiration. As we see, we enter on the curved red line into the profit zone around $86, not quite the break even of 90.30 because of the proper structure. And on the right, we see that even only 1 day away, if the stock moves up to just $83.95, we'll have a profit of 39 cents on the position. We still have a positive upside delta, and if we gain $1 on the stock, we may lose slightly on the put option, but we'll still be gaining 45, 50, or possibly even 60 cents on the entire structure of the position. Now, we're not just going to enter the married put and expect it to go up in price. It is a bullish strategy, and that's what we want. We're going to use income methods in the short term to lower that initial at risk, lower that break even, and generate more profits. We'll talk about that in another presentation. Let's move forward and talk about the 3 core principles of radioactive trading and the proper structure. Our 3 core principles: we need to force an ideal size trade, F.I.S.T. We want to enforce proper position sizing and controlled risk to keep ourselves and our fellow investors out of trouble for uncertain markets. Radioactive or time decay curve. With options, we see rapid decay at the closer expirations, 10, 15, 30 days away. But the longer term options decay more slowly, which means when we're buying a position, that slower decay is working in our favor in the proper structure. And the at-the-money bell curve. The at-the-money bell curve shows us that the highest time value is any option that is closest to the strike price at the money for any chain of an expiration date. This means that we want to buy options on the outside wings, in the money or out of the money, to pay less into that time value that's working against us. We want to be selling at the money to get the highest time value to put time on our side. Forcing an ideal size trade. We already saw the controlled, limited risk that's possible with just the proper structure. We're invested in a position, we're going to buy the proper put, matching the structure that we discuss in the blueprint to control risk to only 5, 6, or 7% against the investment. But there is a second layer of protection. We're going to make sure that that monetary at-risk amount for this position represents only 1 to 2% of our total portfolio value. On our Schwab example, the maximum risk on the trade was $5.30 or $530 for a 100-share trade with 1 put to protect it. If we had a $100,000 account, we would only buy 200, 300, or maybe 400 shares of stock and 2, 3, or 4 puts to match that number. This would give us a maximum risk of only $1,060, about 1% of our $100,000 account, or $2,120 for 400 shares, just about 2.1% of the total portfolio value. So even if we did realize the maximum risk on the position, we only lost 5.9 or 6% of what we invested into the trade, and that would only represent 1 to 2% of our total portfolio value. The time decay curve, the radioactive decay. Rapid decay with options happens in that last 15 to 30 days. Now, this is great for option selling and when we apply the income methods against the married put structure. But it's opposite of what we want for the cost of the insurance and the proper structure itself. Options further out in time will decay more slowly. Buying the put option 150, 200, 300, even up to 500 or 600 days out in time means we're going to see a lower decay in that first 30, 60 to 90 days, 120 days into the trade. The time value is the true risk of the married put position, and in the proper structure, it decays more slowly and gradually to start with, so we retain more of the put value, that second working asset, when we enter the position. And the third core principle, the at-the-money bell curve. Look at any option chain. For any expiration, the option call or put that's closest in strike price to the current stock price will have the highest time premium. In and out of the money options on that same expiration date comparatively will have a lower time value. Yes, the in the money option will contain both intrinsic and time premium and might have a higher cost, but you're guaranteed to get the intrinsic value back. We want to be purchasing into lower time value. We want to buy on the outside wings of the at the money bell curve, in the money or out of the money. The preferred structure we already showed applies all three of the core principles to the proper structure. Forcing an ideal size trade, 2 layers of protection. The purchase is limited to single digits, and we're going to make sure it only represents 1 to 2% risk of the total portfolio. The radioactive or the time value decay. We want to buy insurance further out in time to minimize initial decay. And then we're going to apply income method selling premium closer in to get that rapid decay in our favor as we lower that initial low risk, lower the cost basis in the break even, and potentially bulletproof the trade. And the at the money bell curve. We're going to buy on the wings to reduce the time value cost. And then when we get to the income methods, when it's the proper time, we're going to sell premium at the money for the best time value. But why that more expensive put going in the money and far out in time? Why not buy an out of the money put that has a lower cost basis, or shorter term, which would definitely have a lower premium price? Well, think about it as insurance. Insurance for your car, insurance for your home. You get what you pay for. We found this initial Schwab trade using the Power Options default search for the married puts, following the rules in the blueprint and the radioactive trading principles. Once we found that, we linked to the search by symbol tool to see other combinations in the same June expiration. Now this gives us a great view of the preferred structure. Highlighted in red is our June 85 put, cost basis at midpoint around 755, which gives us that maximum risk of only 5.9%. Now, I could pay half the price and buy the June 75 put for only about 373 or 375 at midpoint. However, the insurance does not kick in until the stock falls to 75, which means we're already down $7.65 on the stock. Now the insurance starts to kick in. We paid $373 for it, so the maximum risk is $11.46 or 13.3% of what we invested in the position. Why is this important? Because it works with the lie of leverage and also what is called gambler's ruin or the martingale curve. If I take a 5% loss on a position, I only need a 5.2% gain to get back to break even. If I take a 10% loss, I need an 11.1% gain on what I have left to get back to break even. If I allowed this position to take a 13 or 15% risk and the stock unexpectedly fell due to poor earnings or some other event I could not see on the stock chart or against my market expectations, a black swan event occurs, for example, I suffer a 15% loss, I'm going to need closer to a 20, 8% gain on what I have left to get back to break even. Of course, you see here, if we go deeper in the money, we might have a low risk of only 1.9%, but that's not the preferred structure exactly. We want to keep it around a 4, 5, 6, 7% risk, maybe 8% risk on the position, so the expectancy of profit is not too far gone. Now, why go far out in time? Why not buy cheaper, shorter-term positions? Here we see highlighted the 85 put for January 27th, 29 days away from December 29th. Here we have a maximum risk of only $1.81, or only 2.1%, compared to our risk of about $5.30, or 6% for the June position. But that June option is 6 months out in time, close to it. A little bit about 5.5, but it's not 5.5 times the cost. The June 85 put would have cost us $7.65. Here, the January 27th 85 put, 29 days away, is priced at midpoint at $4. If I buy month by month by month with the cheaper insurance, I have a higher annualized cost. The risk per day, 181 or 2.1% for 29 days, is much higher than a risk of 530 or 5.9% for 169 days. That second principle of the time decay curve, if we buy shorter term, we see a much more rapid time decay on our option. Buying longer term, we'll see the slower time decay and have a lower annualized cost. Our preferred structure is cheaper at risk per month or per day than buying the cheaper, shorter term puts as well. Let's take a look at that a little bit more in depth, the time decay of the better, cheaper, shorter term put. Let's say that we did enter the 27th of January 85 put only 29 days out in time, which had that cost basis of $4. It's still slightly in the money, but it's only 29 days to expiration. Down below, we see a feature of the Power Options profit and loss chart where we can calculate the expected value or change in price of our options if the stock's trading at a certain price on a certain day. Let's say that Schwab stayed at 82.65, 82.66 for the next 29 days on January 27th, 2023. We would expect to see a decay on our 27th of January 85 put from $4 down to $2.34, or a loss of $166. Does that make sense? Absolutely. We'd be right at the expiration date, 29 days away. Stocks trading at 82.66, we have the 85 put. It would just be worth intrinsic value, just $234. So we lost $166 of our purchase price, the time value decay. Over on the right is the same calculate feature, but using the 16th of June, 169 days out, 85 put. If Charles Schwab remains at 82.66 to January 27, 2023, 29 days away, we'd only expect to see a decline of 76 cents or $76 on our farther term put option. Half of the decay we'd see on the shorter term, cheaper, better put for the 27th of January that was 29 days out in time. Was that shorter term put a lower cost, $4 versus $7.65? Absolutely. But because of the proper structure of the radioactive married put position, even 30 days have passed, we lost a smaller amount on the farther out put because of the time value decay curve working in our favor. Cheaper put, cheaper insurance is not always better. The preferred married put structure, the first step of controlling risk and stacking the market odds in your favor, satisfies the three core principles: forcing an ideal size trade, the time value decay curve, putting time on our side for the insurance, and the at the money bell curve. It is better than cheaper or shorter term puts that you might be used to when you see the married put discussed, talking about buying a 1 month out of the money put for a cheap cost. The proper structure gives us a lower annualized cost for insurance, and we have less time decay up front compared to that better, cheaper option. Now, there are certain guidelines that you want to follow beyond what we just shared in this presentation. We know there is such a thing as too much risk on a position. If 2020 didn't teach us that, 2022 definitely taught us that with the whipsaw markets and a lot of the black swan events we saw. But there's also the risk of too little risk, going too deep in the money, taking too small of a risk where your expectancy of potential profits is going to be too low. And that's one of the reasons why you really need the full details of the proper structure that's described in the blueprint. The blueprint is the full course on the proper structure to control risk for uncertain markets and applying the three core principles to your trades and to the proper structure. And then the blueprint goes on to teach the 12 plus different income methods to further profit on the position, to generate income to lower that initial low risk on the trade to where you can potentially cancel all of the risk on the position, meaning you're bulletproof going through things such as earnings, other events, or potentially black swan events and uncertain markets. But the full details are only described in the blueprint, and you only have a few days left to take advantage of our end-of-year special promotion to lock in the 8 bonuses with your purchase of the blueprint. The special offer does end December 31st at midnight. The 8 special bonuses: bonus number 1, you can receive your first 2 months of the Fusion subscription at RadioActive for only $10 per month. It's usually $69 per month. The Fusion subscription contains timed lessons to help accelerate your learning curve of the blueprint material, basic search to analyze new potential married put positions, the stock insurance tool so you can see how you can protect your open stock positions right now with the proper structure and the proper put, and you can follow along with our trades that we post in the Fusion portfolio following the blueprint and the radioactive trading techniques. Bonus number 2, we're going to send you one of our Mastery Series videos, the Foundations of Radioactive Trading, or the Forts video, completely free. You'll have full access to that electronic video the moment you purchase the blueprint. We'll also give you access to the 4 Insider Secrets of Trading, the F.I.S.T video, a compilation of our most requested replay webinars. We'll send you the Quick Start Guide as well to help you eliminate the guesswork about transitioning from other strategies into the protected married put radioactive trading techniques. You'll also receive 1 month of the patented Power Options tools for free, allowing you to search, analyze, track, and manage your various options, trades, and positions, of course, including the married put structure and evaluating potential rollout opportunities or income methods as the stock moves up and down. But you can take advantage of that at any time when you purchase the blueprint. You don't have to start right away. The 1 month free of Power Options and the 2 discounted months of the Fusion portfolio don't start until you first log in or first access those subscriptions. Well, bonus number 6, instant access. The blueprint is now an all-electronic copy on our educational portal, learn.powerup.com. This means no shipping, no waiting for arrival, no binder to carry around. The information is always at your fingertips. Of course, you also receive email support and phone support for free. If you need help on explanations, clarifications of any of the principles, setups, income methods, management techniques, or more, you can call, schedule a coaching session, send us an email at any time. In addition to that, there's also a variety of members-only webinars and white papers for Blueprint owners. You'll receive instant access to that. You'll be able to log on to RadioActiveTrading.com as a Blueprint owner. Doesn't count as your log on for that fusion, discounted 2 months, but you'll be able to access the members-only content and more. In addition to that, the Blueprint comes with a guarantee. If you purchase the Blueprint before December 31st at midnight to lock in your 8 bonuses, but after going through it, you feel it might not be for you, or maybe you want to take some time, you can request a full refund, and we'll give a full refund for the Blueprint purchase, no questions asked. But remember, there's only a few days remaining. So you want to act now to lock in the special bonuses for the end of year promotion, to start controlling risk for uncertain markets, to put the 3 core principles of trading at work for you, and to start stacking the market odds in your favor and avoiding market uncertainty.